And this is Jacqueline A. Olarte, and I'm going to be reporting about the efficient market hypothesis, rational expectations in financial markets. While the monetary economists were developing the theory of rational expectations, financial economists were also developing a parallel theory of expectations formation in the financial market, which is called the efficient market hypothesis. So, efficient market hypothesis is based on the assumption that prices of securities in financial markets fully reflect all the available information, and it also assumes that all stocks are being traded at their fair market value. And this theory was developed by an economist named Eugene Fama. So since the price of the stock reflects to all the information out there, only the new information will automatically move the price of the stock. And the efficient market hypothesis goes through by stating that since stock price are already reflect all publicly available information, it is impossible to beat the market on a performance perspective on the long run. It's because, unless of course we have more than publicly available information such as insider information, that would be very useful, but at the same time it is illegal. And the major conclusion of this theory is that since stocks always trade at their fair market value, it is virtually impossible to buy undervalued stocks on a bargain or buy overvalued stocks for extra profits. So the rationale behind the hypothesis. The main rationale for this theory is that in an efficient market, all unexploited profit opportunities will be eliminated. So as long as the few people keep their eyes open for the unexploited profit opportunities, then they will eliminate the profit opportunities that appear, because in doing this, they will be able to make a profit. And also the elimination of the unexploited profit opportunities, which is necessary for the financial market to be efficient, it does not require that all market participants should be well informed. And this hypothesis thus makes sense because it does not require that in a market to be cognizant of what is happening to every security. And for those who support the efficient market hypothesis, they say that fundamental analysis is pointless. It's because since once the information becomes available, it quickly reflects on the price of the stock. Along the same lines, the technical analysis is also useless for the reason that the past cannot predict the randomness of the future. Like for example, there is a stock available today for 1,000 a share, and according to the efficient market hypothesis, it is its fair value. So any research we might conduct, it would be simply pointless because the market is reflecting the current fair value of the stock. And also there is no way to identify fair value that is more accurate, since all the information that can be used to calculate the value is already available to the public, and therefore the price of the stock. And then there are variations of the efficient market hypothesis, and these three, the weak form, the semi-strong, and the strong form, have the differences. And their differences is that what information will be useful and what information is not useful. So first is the weak form. So the weak form, the stock prices reflect all available information and goes further to say that past performance is irrelevant to what the future holds for the stock. So in this level, the technical analysis could never work for the reason that the technical analysis relies on the history repeat itself or based on the past trading data. Although the fundamental analysis in this level could be used. And for the second one, the semi-strong form, It assumes that the prices adjust quickly to any new public information that becomes available. Excuse me. So the price of the stock is quickly adjusted based on the new information, and it could be about a news article, an analyst report, or about an earnings report. And at this level, the fundamental analysis cannot be used to achieve on a risk-adjusted returns. For the third one, the strong form, which holds that the prices always reflect the entirety of both public and private information, whether it would be an historical, new, or current, and also an insider information. So at this level, it implies that no investor can beat the market or a risk adjusted on the basis on the long run. For the reason that if an investor is willing to take risk, then surely that investor would get higher returns. So on the long run, stock prices reflects all publicly available information, and therefore, since we all have the access to the same information, then no one can beat the market. And that would be all for my report. Thank you and power.